Hello ACU students. This week we're closing out Chapter 6 and the end of this course. Our learning objectives this week include preparing an income statement and recording the merchandising transactions under the perpetual inventory system. We looked at the perpetual inventory system last week. And so this week we're looking at preparing those income statements and doing some of the journal transactions related to that. Similarly, we're looking at the income statement and journaling transactions for the periodic inventory system, also found in Chapter 6 there. And then finally, we're looking at the role of the operating cycle, understanding and explaining the operating cycle and evaluating, again, the notion of liquidity of a merchandising company. It's a little bit different than the liquidity numbers that we were looking at previously. Calculated a little bit different. As a reminder, in a perpetual inventory system, management wants to always have a current inventory balance. Under that system, inventory records are continuously updated, providing management with up-to-date information regarding the inventory levels. In a perpetual inventory system, the merchandise inventory account is increased for the cost of goods purchased and decreased for the cost of goods sold. So, think about it like this, like a wave coming in and out. Inventory coming into the shipping dock to be sold, and sold inventory going out the front door. Causes the merchandise inventory account to ebb and flow. So product coming in the back door and then being sold and heading out the front door. And all the time kind of the inventory is moving back and forth between shipping dock and front of door, impacting that merchandise inventory account and the cost of goods sold account. More specifically, in a perpetual inventory system, the following accounts are impacted: the merchandise inventory account, accounts payable, the freight in account, cash, sales, the sales account that is, cost of goods sold account, delivery expense account, the sales returns and allowances accounts, as well as the accounts receivable. Now, to show exactly how these transactions impact the journal, I've included a list of the journal transactions for a perpetual inventory system in the materials needed for success tab that's in week 8. Now, as you recall from last week, the other method for managing inventory is called the periodic inventory system. In this system, a manual count of inventory on hand is taken periodically. Usually it's the end of the accounting period. Now, I've done these before, very painful, takes a long time, very exhausting. But that's oftentimes how it's done. In fact, in large companies where I've worked, we've done both perpetual as well as a manual once a year or once every 6 months. Now, the periodic inventory system, or that manual count system, though simpler and there's no detailed records that are kept, the periodic inventory system does not provide management with continuously updated current inventory balances. We learned that last week. Again, just like the perpetual model, in this periodic inventory system model, you can see the same accounts are impacted, but the transactions are different. And so, as I was showing you the inventory as I showed you the inventory management system journal entries, transactions that are in the materials needed for success in that tab for week 8, there's also one in there for the periodic inventory system, because those transactions are different between the perpetual inventory management system and the periodic inventory system. Again, check out the materials needed for success tab that's in week 8. Finally, make sure you check out section 610 in chapter 6 about the operating cycle of a merchandising company. Here's basically how it works. The owner or the business people running the company, they would purchase merchandise inventory from suppliers for either cash or on credit, and then they would sell that merchandise to customers, again, for either cash or credit, and then they would collect cash from customers who had the credit sales, and then they need to find a way to pay for the purchases that they made on credit. Now, to have sufficient cash or cash flow, if you will, on hand to pay bills and to reorder merchandise inventory and to reorder merchandising inventory, management in a merchandising business must do a very good job in forecasting its future cash needs. Typically, a line of credit is needed to cover purchases from suppliers while cash is collected from customers. So you've kind of got this outgoing cash need to pay suppliers, but you're still waiting for your ship to come in, if you will, on the sales that you made. So while net profit is important, while net profit is very important in a business, cash is king. All businesses need to make sure they have enough cash to pay the wages, cover the bills, etc., and reinvest in the business. All right, that's the overview for this week. Make sure you read the last sections of Chapter 6. Don't slow down yet. You're almost to the end, so keep going strong this week. Remember, God is on his throne. He's always been there, and he's always going to be. Have a great week.